Hello and welcome to the Alt Asset Allocation Podcast. In this conversation, I sit down with Chris MacIntosh. He's a managing partner at Glenorchy Capital and an author at capitalistexploits.at. And we sit down and have a wide-ranging conversation on how to position your investment portfolio, very similar to some of the other ones. There are trends like greenwashing that are in full force. But have you analyzed what this really means and the associated investments involved? Greenwashing is just one tiny piece of the bigger picture. What are the second order effects of these shifts and how to position your portfolio accordingly? Chris is incredibly knowledgeable about these topics and goes into great detail on why many materials, such as copper or nickel, might be poised for more upside over the coming years and why investors should be bullish on energy in general. Before you listen, please don't forget to like or subscribe to the podcast, or even better, leave a review. This really helps more people find the podcast and keep the thing going. It really, really helps. There you go. Enjoy this conversation with Chris MacIntosh. Chris, excited to have you on today. Welcome.
It's great to be here. Thank you. Thanks for having me.
Yeah, absolutely. Other side of the world. So happy to make this time change work. So I found you from your fantastic blog post, Investing for the Greenwashing Bubble. And I definitely want to go a lot deeper into all things climate hysteria, greenwashing. But first, you've been featured on a number of podcasts. But for my listeners that don't know who you are, can you give a little background about who you are?
I run a macro asset management firm called Glenorchy Capital. We manage private money for basically high net worth individuals and a few institutions. What we're looking at doing there is really, it was originally designed as a true hedge mostly against some of the risks that exist in the market, and increasingly, I believe, and we can talk about this as we go forward, it is what we're doing is actually more than just a hedge. It's increasingly one of the only sort of places where we're investing is some of the only places that actually do make sense to invest in the current world, which is very unique, shall we say. So there's that, and then the research that we do for that, we decided that we would actually put that out to people that couldn't afford our services or didn't want them for whatever reason, whether you might be some asset manager who you manage your own book. So we've got a massive plethora of different types of clients that actually buy research, which is really the culmination of the work that we do for Glenorchy. And so we sort of put that out as like a smorgasbord of our thoughts and our ideas and so on and so forth. And so that's the crux of it. That's what I'm doing now. I've got a background in investment banking way back 100 years ago. That was sort of where I cut my teeth, and then left the corporate world to sort of venture out on my own. And I built a real estate business, investment and trading business way back in the mid 2000s, which was short and sharp. So I sort of built that and ran it for about 5 years, and then sold that all up in September of 2006. That was just based on a trend that I sort of identified there, which was this ridiculous pushing down of interest rates. So subsequent to that, I then built a venture capital firm based on what I deemed to be a large trend unfolding, which was a movement of capital into risk assets. When you can't find yield in the market, which is certainly the increasing problem that we've had for the last 2 decades, really. In order to have a portfolio that returns what you would want, one has to take more risk somewhere. When your yield component, your bonds are not returning what they should realistically or theoretically return, then you have to get that alpha from somewhere. And so that somewhere is is in riskier assets. And so I asked myself, I said, okay, well, what is the riskiest asset class, if you will, and that's venture capital. So that was one component behind it. The other component was, while that was taking place, we had a significant move in terms of bureaucracy for companies which are going public. The costs to going public were just increasing dramatically. The compliance, all of that bullshit that you have to do, just got worse and worse. And so what it meant for businesses was that that carrot of accessing the capital markets wasn't as juicy as it might have looked otherwise, and the stick was getting bigger. And so I was like, money's just going to stay private. Why would it go public? That dynamic's changing. Anyway, so long story short, I built a venture capital firm to try and take advantage of that shifting capital, which worked. And then by 2015, I looked at that and thought, this stuff's nuts. This is just, it's bizarre, and I can't be putting my own money into this anymore. And hence I can't be putting client money into it. So that I sold in 2016. As we now know, the market carried on for another at least 2 years, to the extent where we had all sorts of fun like WeWork and all of that. And while that was taking place, I've been doing really what I'm doing now. I'm looking at the markets and the sort of geopolitics of the world and so on and so forth, and really just training my own book along with a very good friend of mine, Brad, who now runs Glenorchy with me. And then we eventually kind of came to the idea or the conclusion that, this opportunity in front of us now is so extreme and so bizarre and so huge that to not do it at a greater level of scale would be doing ourselves an injustice. And so we kind of took the leap to set up what we're doing now. So that's it. That's here we are, and we're sort of, I think, in the first or second inning of what I think is probably the third major trend of my professional career unfolding.
Interesting. Back in those earlier, not so much the unprecedented times that we live in now, but I mean that shift into the risk assets all very much aligns. I mean, so this third wave, when you talk about this big third move of your investing career, you're talking specifically about this greenwash bubble. Is that correct?
That's part of it. That's just simply part of it. The main component behind it, I believe, is basically inflation. We've had this deflationary impact, which really was post-World War II. So post-World War II, we had globalization and expansion of the pie. The pie was like everybody wanted a piece of the pie, and we kept expanding. And you had NAFTA, and you had international trade agreements that were put in place, and was really just bringing more and more participants into that global economy. And so that is always a deflationary impact, especially given that we added 4 billion people or something of that nature to the global workforce that weren't previously in it. And those 4 billion people were prepared to work for $10 a day. And so that's always going to have a deflationary impact on goods and services and everything else that comes out of that particular melting pot. So we've had, that was, an extraordinary trend that we've had really, since Bretton Woods, and it sort of grew and grew and grew. And we could see that was changing. Geopolitically, that was changing in as early as 2014, 15, sort of rising nationalist interests. It's almost like entropy. So you have something that has a momentum, and as it wanes, your desire to get more and your ability to get more out of squeezing that particular orange diminishes. And so the whole psychology of individuals and the psychology of nations and the psychology of cultures and everything else goes with that. And so that then translates as well into politics. And so you could sort of see this angst coming through, and so we felt that was going to certainly go about causing a shift in from deflation to inflation, where that globalization was an inflationary impact. We were going to go through a deglobalization or a lessening of globalization, even if you want to think of it that way, which, even if it just changed at the margins, would have added a significant change on asset classes, largely as a consequence of this status quo situation that you and I have experienced for our entire adult lifetimes, which has been that experience. It was pretty easy. You just invested in certain asset classes. You could sit back and go and drink a beer and not worry too much about it.
Yes, enjoy your cheaply manufactured goods and all of these things, right?
Yeah. And what that does is you have that feedback loop where you become more and more certain with outcomes, because the longer something lasts, the more certain you are that it'll continue to last. When in actual fact, that may be the case, but not always. And certainly where the dynamics underlying it are changing, and it continues. It's like building a tower that goes higher and higher, and you don't build your base any wider. It's at some point it's going to fall over because it doesn't have the ability to stand. The infrastructure or the foundation of it is insufficient for its continued height. And so that's broadly what happens in any market, in any bull market. And that's what we felt was going to take place with respect to that deflation versus inflation component. And again, we only needed little changes for that to be fairly dramatic when you look at the various sectors that we're interested in. Many of them are down 80, 90% from their highs. Many of them have massively curtailed supply. I could talk about all sorts of industries. I'll throw out something like uranium. Uranium industry is roughly 90% of the companies that existed in the previous bull don't exist at all anymore. They're gone, vaporized. They just don't exist. And so what happens is you have a concentration, because that industry still exists, but the participants in it are much smaller, but they now own 100% of the industry. So that's a concentration of that industry. And that's been happening in many different sectors. So that's sort of where we're very interested. And that provides one with a significant hedge, but also coincidentally an also sort of asymmetric opportunity on a go-forward basis. That broadly is what we're looking at. And then there's things like the greenwashing you mentioned, which come into that. So energy as an example, there's this hysteria around climate change and the desire to rid ourselves of carbon emissions. And so the target for that has been oil and gas industry largely, amongst others. And so we've seen incredible divestment of capital out of those sectors, out of those companies. And even within companies themselves, many of them in the Western world have basically committed suicide or are in the process of committing suicide, whereby they're saying, yes, we're an oil company. BP is a very good example. So BP have come out and said, we're no longer going to be investing in fossil fuels. So if you do want to be long energy and buying or long fossil fuels, and you go out and you buy BP, you're not getting that, because they've said that they're not going to be doing that. And so all of that contributes to supply destruction, enormous supply destruction. And then the companies that do want to play in that space can't get funding. You try and get funding as a pension fund, as a sovereign wealth fund, they've all been divesting of those sectors. And I say all, it's not in the Western world, they've been divesting of that. Right. So that presents us with a very unique set of opportunities, because unless some miracle comes along, we are not, this transition that it keeps being talked about is it's not a transition. It's mathematically not happening anywhere near to the extent that the mainstream media is putting out. And even where it is gaining some sort of ground, the old world, if you will, isn't going away in any shape or form. And that's been true of mankind's history. From when we transitioned from wood to coal, when that took place, we continued to utilize the same amount of wood as an energy source. What we did was we added capacity, and then we used coal, and coal became the dominant force. And then when we transitioned from coal to natural gas and nuclear, coal remained. What happened was the overall share of energy consumption got taken up by natural gas and oil and nuclear. But what happened was we just added energy consumption. Right? It's not a net zero world, in that every time we've had the ability to come up with some new technology, we've expanded. We haven't said, oh, that's a flat world. It's a bit like a cell phone. I remember we used to just be able to make a phone call on with the old bricks. Now, then they added capacity. Now you've got like how many gigabytes or bloody terabytes or whatever of storage capacity and everything else on your phone. And, even 10 years ago, we would have looked at it and said, do we need all of that? And we would have scratched our heads and not really necessarily be able to come up with what we would do with all of that storage capacity. But here we are today, and now we're streaming videos. You and I are talking on some, so we just add capacity. The same thing is true in the energy world, and that's always been true. So what we're looking at now is this idea that we're going to not only add this new component of renewables, which in themselves don't mathematically compute, but let's pretend that they did. Let's pretend that we were going into this world where solar and wind and unicorn farts were going to be the biggest thing. We would still utilize natural gas, coal, oil, all those old things to the same extent. And so when we look at that space, it's not actually possible at this point in time, given the investments that are in those spaces. And so the only way that corrects itself is with an increase in the price of those particular commodities. So that's a unique set of circumstances. The other flip side of that is, if we do look at this renewables, and I'm not discounting renewables entirely, there is a space for them, and certainly there will be technological advancements, and we will have there will be more usage of them. Be that as it may, if we're going to transition to this world, if you look at the underlying factors, which few are prepared to do, and we say, okay, what would it take to actually achieve this? In other words, if we just take, we did a study which we published for our publication probably about a year ago now. What we did was we looked at the United Kingdom, just as an example, and we said, okay, the government there has come out and they've said that this is what their projected plans are for this carbon neutral world, and by 2030 they wanted to have 50% of the cars or electric and da 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 da. Anyway, I said, okay, fine, sounds good, sounds wonderful. What is it going to take to actually get there? We're going to need incredible investment in battery technology. We're going to have to then power those batteries, which means a massive build out of the grid, because the grid can't compete and is struggling now. So if we're going to move to this, we're going to have an incredible investment into the power grids. And you basically, setting the power grids aside, just looking at the battery components in that, what we found was that by to achieve these goals that they had said, we were going to consume all of 2018's copper supply, global copper supply. And so that would have meant that every other country in the world would no longer utilize any copper. And we found the same things with cobalt and lithium. And then that, again, that's not even looking at the energy, the grid build out, which is required, which requires an enormous amount of steel and and you can't make steel without coal, metallurgical coal. That's how we make steel. And so these green ideas of saying, oh, it's just electricity. It's like, well, where does electricity come from? It comes from power plants.
Non-renewable sources, right?
Typically non-renewable sources. And so even if we look at wind turbines, they take a fuckload of steel. You can't make steel without the coal. So we need to have coal mines.
Well, and the big machines required to actually put these things up, right? I mean, they're flattening the earth. They're bringing in diesel-powered trucks. They're put on diesel-powered ships.
Incredible amounts of diesel.
Right.
And so it's all fine and good, this facade of, oh, it's going to be green, and you put up pretty pictures of flowers and birds tweeting, and you go, this is what the world's going to look like. And you go, cool, let's break it down. And you break it down and you realize that it's a complete facade. It's just absolute garbage. Now, to a certain extent, we don't actually, we don't need to rant and rave about this. We can simply look at those markets and say, fine, one or two things is going to happen. Magic happens, which is renewables, but it's going to require enormous amounts of copper, cobalt, steel, etc. And you look at those markets, copper's all-time low. Many investment funds, and we're not one of them, fortunately, because we don't answer to anybody other than ourselves, are not allowed to invest in them. And so if that world is the one that takes over, we're going to have a massive bull market in those underlying resources that are required to make that happen. And history would indicate that's not going to happen, and we still will utilize these other resources, and those have been divested of massively. And so you kind of can play. It's a heads I win, tails I win situation to a certain extent, which is extraordinary because I've not typically seen that sort of setup in my investing career. So that's one of the components that we're very interested in. And then further to the topic of deflation versus inflation, when you increase the cost of energy, you increase the cost of everything. How do you manufacture when your cost of energy is higher? Well, you do, but you have to pass on that cost in some shape or form. And so you might not make any more widgets. In fact, you might make less widgets, but they're going to cost more. It's just the way it is. And then once you've made them, you've got to transport them. And
pass on that increased cost right to the end consumer, right?
So that it's, yeah.
So to summarize, I mean, this transition will likely happen, but it's just not as quickly and not as clean of a turn off this old and turn on the new as a lot of people are pricing in. Is that kind of the core thesis here?
I don't think transition is the right word because, and I know we've utilized it in the past. We've utilized the word transition when we moved from coal to natty gas and oil. But if we go and we break down those numbers and we take a look at what's happened in those markets, the reality is that we still consume actually more coal today than when coal was the sole dominant source.
But that's probably net consumption is up, right? I mean,
so even if we just use the same amount, yes, we might have this quote unquote transition, which is really just meaning we're going to utilize other sources of energy more than we utilize those. We will still need those sources of energy. And that's, at this point in time, going to be very difficult because there's been no investments made in them. And so we're setting ourselves up for a problem. And then, as if that wasn't bad enough, and I hate to be a bringer of bad news, but while that's taking place, there's also a geographical component here, or a geopolitical component. So there's this extraordinarily strong push in Western nations to divest of fossil fuels and to punish anybody that does. Now, if we took Germany is a very good example. So Germany has been at the forefront of going green, we'll call it. And so they got rid of their coal-fired power stations, their coal mines. They got rid of their nuclear because they said that was dodgy. And they now have the highest cost of electricity in all of Europe. They also import their energy from France, which is nuclear, and Poland, which is coal, and Russia, which is natural gas. And so all that they've done is they've
outsourced.
They've just created a third party for their energy sources while costing them more. So they can stand up and say, oh, we're clean and green, because Germany's dotted with these horrendously ugly wind turbines, which they've used and don't work, basically, to the extent that they really need to, clearly. And the other component behind that is they have subjugated themselves to foreign players, because you cannot, and I keep saying this, you cannot have political security when you don't have energy security. And so now, you know, and while they've been doing this, they've been pushing this through the EU, through the United Nations, through the World Economic Forum, through these international monetary funds, these various organizations. They've been forcing other countries to toe the line and do the same thing. And so much of Western Europe is under their thumb. And what ultimately is happening is that much of Western Europe is now under the thumb of Russia, because that's where their energy comes from. And so this is happening on a global scale. And when oil traded at minus 40 back in February of this year, one of the reasons that took place was obviously the lockdowns and the subsequent demand destruction. But while that was taking place, the Saudis and the Russians looked at this and said, this is our opportunity to completely vaporize our market, our competitors. And so they just flooded the world with oil, knowing that they were doing it at below cost, knowing that nobody needed it. Which incidentally, one of our trades then was to buy tankers, because all the above ground storage ran out. And where are you going to put it? You put it on tankers. So, but that's just an aside. The point is, they put out of business largely shale. Nigeria's shuttered many of their wells. Mexico, the same thing. Venezuela already shot themselves in the head by instituting Marxism, and so they're not a player any longer. And what we've had is this extraordinary concentration of wealth in the Middle East and Russia. And that's where we stand today. So it's not just a sector play, but it's a geographical, geopolitical play at the same time. So one needs to be a little bit careful with respect to how you execute on that trade.
Absolutely.
Like I said, don't go buying BP thinking that you're going to want to be long energy.
Right. And I definitely would get into that, like how an investor can actually play this. But I mean, no country has political security without energy security. I think that and you've said it multiple times in your blog post, but it is a very, very valid point. But I think at the same time, I mean, there's no way that the world runs without energy, whether it be produced from fossil fuels or clean energy or what have you. I mean, the world runs on energy. And I know you've done quite a bit of work, at least in that blog post, about breaking down the different types of energy sources. I mean, from an investor perspective, I mean, are you bullish on uranium? You're bullish on oil and gas? Like, walk me through kind of how you choose to play this, I guess.
The answer is an easy one. And the answer is that we're bullish on pretty much all of them. So they all have different dynamics behind them. The critical thing that's really extraordinary at this point in time is there's two things. One is we have extraordinary supply destruction, okay, across the energy space. In the Western world, we've taken this view that Anybody that's in the fossil fuel space is, you and I would be better off beating babies to death with baseball bats than getting into that energy industry.
It's so true. I mean, if any of these things, if BP came out with a cure for COVID, people would still hate it, right? They've divested their opening coffee stores at this point, and it was like the market rewarded it. It's very unloved, to say the least.
Yeah. You could look at that and say, wow, in a normal world, and we don't live in one of those, in a normal world, you would have this transition where capital was actually making that decision. Capital was saying, we're not investing in this, but we're investing in that. And that being an alternative, right? And so when you look at the wind and solar and these alternatives, some of the solar companies are flying. That's done well for us. But when you look at the underlying components, you say, okay, well, how do you make Tesla's flying because people are going, oh, well, we're going into this world where everything's going to be an electric car. If you want to be long Tesla, and I think that's a ridiculously stupid thing to do, but let's just say you wanted to, you buy nickel. That's what you buy. Nickel is dirt cheap. There's insufficient supply of it. If we're going to have thousands and thousands of these electric vehicles on the roads, we're going to need so much more nickel than is currently being mined. And nobody's investing in it. And so we're interested across the energy space, and we're playing it from multiple different angles. There's that component. The other component, which we alluded to, touched on, which is the geographical, geopolitical one, is I think more important than people realize. So, for example, if you and I went and we invested into an oil and gas company in Texas. Now, at the moment, there's obviously the elections going on. We're going to find out what that all transpires to. But if the Democrats got in, they've already told us that they're going to ban fracking. Okay, so there might be a boom in natural gas, but if we've gone and invested in a company that's in that geographical location, it goes to zero or close to. So we've got to be very careful increasing across the sort of geopolitical space as to what do you invest in what country and where. And so watching those trends is very important. We are 4, maybe 5 months ago now, went through our entire clients' portfolios, and we broke down companies by domicile, where they're listed, and then where their assets are. And so when you break down each of these companies, you look at it and you say, okay, if you've got assets in a particular jurisdiction which is not looking favorable towards that industry, that's a real problem. If the company itself is domiciled in that region, that's less of a problem. And I'll give you a description, an example of how this is likely to play out. So I grew up in Africa, in South Africa in particular, when they had something called black empowerment coming in. And basically what they said was, okay, you've got a company here. We need to change the ownership structure of this. We need to give 10, 15%, whatever it is, towards this new group of people. And basically, that's what's going to happen. And so what the companies did, especially if you were a large corporate that had assets all over the world, what they did was they said, okay, we got, let's say, a mine in Namibia, and then we've got stuff in Australia, and we might have something else in Indonesia, and then we've got some of these assets in South Africa. What they did was they just stripped them out. They said, okay, we'll form a new entity here. This new entity here owns all these South African assets. That gets diluted down because we don't have a choice. They're going to take it, and that's what it is. But all these other entities that they've now created, they just go and create a new entity in say, London, that listed on the London Exchange, and then we just buy the Namibian assets or the Indonesian assets or whatever it was, poof, and you're off. It's gone. And that's what happened. And so it didn't. So for the countries coming in and the bureaucrats coming in trying to steal essentially those assets, they could do that where they were where those assets were under their own purvey. So that's where it's important. So we've looked at our whole portfolio and we've looked at the various countries and which sort of path they're going down, and said, okay, we want to have them in favorable jurisdictions. If this does happen and you've got a company that's, say, listed in Canada, which is really the resource capital of the world, but their assets are in Ukraine, doesn't matter. Because if that hits them, they'll just go, fine, we'll set up a new company in Ukraine, we'll sell the assets to them and we'll just walk away. You can't, like, what are you going to do? But where the assets are domiciled in that jurisdiction where they can steal it, that's a significant threat. So the other side of that is just actually looking for, companies that are sort of outside of regions in the world that we're having this hysteria take place. We just don't have an interest in taking that risk. So it's a very interesting time to be investing because it's got so many different elements and components that are taking place.
There's so many moving parts, and something that I'm always thinking about is if there becomes somewhat of a self-fulfilling prophecy because of capital flows, right? I mean, you may make the right call, but because of the political environment or the way that capital is flowing, that correct thesis doesn't play out, and you're fighting against these forces that are so much bigger that even though this makes sense in theory, you're fighting against bigger forces. So that's always in my head with a lot of these plays, because in my mind, I mean, something like nickel. So it's like, okay, so if Tesla's takes off and everybody's driving a Tesla and UK bans all fossil fuel cars, even though logically it doesn't make any sense, like from your article, I mean, passenger cars are 6% of the CO2 emissions. Like, it's nothing. Don't focus. You're looking at, you're measuring yourself to the wrong thing. But if every country in the world bans fossil fuel gasoline powered engines, then everybody's going to drive a Tesla, and that's the play. So nickel goes wild. So I think this is where there's a buyer and seller on every market, right? So
there is, and there's other components. I love looking at second order effects. So because sometimes the first order effects get priced. In this instance, they're not yet. But the second order effects of what you just described are higher prices on everything. If we're all to drive Teslas around, what literally will happen is blackouts. We will have insufficient energy to power those vehicles. It's that simple. It's mathematically going to happen. And so all you need to do is go and travel to some third world countries that experience blackouts. And I'll tell you now, none of them experience deflation. Why? Because the cost of producing everything goes up. In a given day, let's say you're going to work 9 hours, but 3 of those hours there's a blackout. Well, you're just not as productive as you were before. It doesn't, or you're going to bring in generators, diesel generators. Right. That's what's happening.
Yeah.
Right. In fact, one of my clients, a very wealthy gentleman who lives in California, bought himself a diesel generator because he's sick of that's for his home. So
his roof is covered in solar panels, and he drives a Tesla too, right?
I don't think he does, but the reality is that you do what you have to do. That's just for his own comfort. But if you're running a business I'm just using California as an example. But
this is the prime candidate for a lot of greenwashing.
This is what happens. Yeah. And so then you get inflation across the board, actually stagflation. And then basically many of our other positions go up as well, because you can't manufacture with the same productivity levels when your cost of energy is higher, or when not just the cost of energy, but your availability of energy isn't there. Where if you don't, for an hour every day, you don't have power, well, that's, I don't know, 10% of your productivity that's gone away. And your OpEx is still the same. You're still going to pay the same salaries. You've still got the same rent. You can't plug that hole any other way than charging more for the goods that you got to produce. And then also what happens is that the marginal players in that space can't make it work, so they go away. What happens? That's less supply. And so you know, I've seen this across Africa, especially because, you know, they don't have functioning markets, and energy is such a big component behind it. People don't realize that, and we're barreling full speed ahead down this path of climate hysteria, which is backed by, as far as I can tell, junk science. And it is what it is. I mean, I'm actually not here to make an argument about climate change. You can have whatever view you wish on that. I'm here to make money. And so it is what it is. And coupled with that is this deglobalization. And with deglobalization, what you get is nationalism. So, I mean, I've written articles about this as far back as 3 years ago, saying that we're going to get trade wars, we're going to get sanctions, we're going to get impediments into functioning markets, and that's supply destruction. The other thing that is likely to take place is we're going to get nationalization of resources. When these things become critical, governments will step in and go, this is too important. We A, have to maybe support it, or B, we're not going to export it anymore, or, you know, it becomes of national security interest. And that's where we're headed to.
Absolutely. So, and we got a taste of that with COVID in the US, right? Like massive supply chain disruptions, because we've been outsourcing this for decades, you know, at such a lower cost, and so much that we've basically forgotten how to do these things on our own. And then you pick it apart a little bit and you realize, actually, we don't even have the capacity to build this on our own anymore. It's been outsourced, and as a byproduct of globalization, which is great for the consumer, lower cost, but when it becomes national security and disasters, it gets pretty nasty pretty quickly. So I'm curious. I mean, you've got on your Twitter, you have quite a few tweets about COVID situation. It seems like we're pretty well aligned with that. And we're recording this on November 3rd. So the presidential elections are going on in the US right now. So here in the next couple hours, well, I mean, honestly, we're not going to know for weeks, right? But, you know, these we should start to have some numbers, and you never know. So I'm curious, what are you monitoring right now? What would change your mind about these investment theses that you have, whether it be prolonged COVID shutdown or change of power in the U.S. or you know, God forbid, something worse? Like, what are you monitoring, keeping your thumb on the pulse of?
Very little. I mean, there's some plays that we've got around the elections. Largely, that's been ammunition stocks, which we bought 3-4 months ago, which have done very well, and we're holding on. But in terms of the rest of the portfolio, they were representing deep value before 2020 came along, and what it's done now is it's just made them. You know, I couldn't have written a novel around what's taken place and had it been believed. And it's just created the most extraordinary setup for these sectors. I couldn't have imagined it. So, it's a bittersweet situation in that it's very exciting to see that taking place and to see the inevitability of what is going to transpire, and being able to hopefully position accordingly to profit from it. And I say bittersweet because what's happening is not good. It's not good for the world. It's not good for humanity. It's not good for societies. And I give up all the profits that we have made and all that we will make to have it look something different. But I can't. The world doesn't work like that. And so the first thing you got to do is just try and protect yourself and work with what you have. So these shutdowns are creating huge supply destruction. Those supply chains that you mentioned have been decimated. They are being in the process of being changed. Many companies have to rearrange how they go about sourcing products, and that's without things like sanctions. And at the same time, many of them have gone away. So again, we have extraordinary supply destruction. I mean, agriculture is one of the spaces that we've literally been looking at that for about 5 years, and we've never done anything about it. And now we're long and very long. But and I've spoken to CEOs across the world in that space. It is phenomenal. And I hate to say it, but we are likely to have food shortages and famine within easily the next 48 months. Just absolutely myopic legislature that's been put forward. These lockdowns are just absolutely insane. To give you some numbers, and this is from the UN, in terms of the number of people that are now globally on the brink of starvation. For every one person that's died of COVID, and that's with COVID and from COVID, so those numbers are a little bit skeptical anyway, but even if we just take that number, for every one person that's died, we now have 35,000 that are on the brink of starvation, likely to die. So the idea that this is about health is just complete bollocks. And we haven't considered the suicides and the alcohol abuse and drug abuse, all of the attendant issues that are yet to come and that are hitting already. So it is what it is. Largely what we're looking at is an extraordinary shift of political, social, and economic power from the West to the East. And it's not necessarily because the East is screaming ahead. They literally are just sitting there watching the West destroy itself and championing it on. I just saw China coming out saying, yeah, we're all for going carbon neutral by 2060. Yay. And they're building over 100 coal-fired power stations. So they pay lip service to it. They champion their competitors to carry on down this path. They champion them to carry on with lockdowns. They locked down for 4 weeks.
Taking the long game with all of this, right? They're fighting a war, and the rest of the West can just preoccupy ourselves with these little battles and our 4-year elections and our little initiatives that over the next 5 years. But China's always thinking 100 years out and how they're just going to crush us, right? And it's securing food security and land in all of these places that are agricultural rich, and playing the very long game. That's the unfortunate reality with a lot of this. And I think for me, I whenever I have these conversations and start thinking about these, and I don't want to go down the whole capitalism is broken, short-termism discussion of those things. But I mean, it's quite easy to get very pessimistic, and at every scenario ends in pitchforks and torches and something very dire. But from an investor perspective, one, how do you stay optimistic? And two, what do you do to protect your portfolios or the portfolios of your clients in these, when thinking about like these long-term moves like this?
It's a great question. I guess the first thing to realize is that the world's been through massive transitions in the past, and our ancestors at some point in time had to make decisions that mean that we are still here today, and they were difficult decisions. The right thing to do 100 years ago, if you were in Europe, was to go to the United States. That was the best thing that you could do. It was the best thing for you. It was the best thing for your offspring. It's just the way it was. Now, that would have been difficult if we were German speaking or Italian or Polish or anything, Russian. That it was difficult didn't make it the wrong decision. It was still the right decision. I feel like we're in a similar situation today. And so when you look at the long arc of history, what we're experiencing now isn't all that unique. It has unique attributes to it. It has technology and it has a whole lot of different attributes. But in terms of the actual experience itself, it's not that unique. So I think to a certain extent that lends you some sort of comfort. You go, hey, humanity's been through this sort of stuff before. We'll come through it. What you then got to realize is that it does represent danger and it does represent opportunity. So I think we can't be myopic to it. And in order to move forward, the best way to keep your own sanity is to have a plan and to work towards that plan and constantly watch and assess to see whether you're on track so that you have some level of control. The worst feeling that you can have is where you don't have control over your life. And I think so for me, the answer to your question is, how do you gain some control? So in our investment portfolios, that's what we're doing, or that's what we believe we're doing. We might be wrong, but we feel like we have a very strong grasp of what's going on, how best to build a diversified portfolio to adequately manage that. Then there are other issues, obviously, around where might one locate oneself, and those are separate topics of discussion. We can certainly talk about them some other time, but there's when you get the sort of massive transitional shift that we're happening now of wealth, that's a massive opportunity. At some point, you're going to look back and people will be going, wow, if you could have just got that half right, that was phenomenal. I spent some time just recently with an old friend in Vienna, and he's of Russian origin, and we were talking about the history of Russia and his background and his family, grandparents, and so on and so forth. And one of the things that was really phenomenal was, when the USSR broke up, those who understood what was going on just made out like gangsters. I mean, literally, that's, now, so, and I'm not suggesting going and stealing things, but to a certain extent, you kind of have the opportunity today to steal things, to get them for prices that are just absurd. So, that's a huge opportunity, I think, to have that kind of setup, the experiences that we're having today, which are troubling and they are stressful and create anxiety. The way to dispense with that anxiety is to have a plan to tackle it head on. that's the best way to do it, I think.
Yeah, so that makes sense. I mean, so a lot of the things that we have talked about, I mean, basic materials, um, oil, energy, uranium, like these are kind of the core theses that we've discussed. But I'd be curious your opinions on store value assets. So, I mean, what 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 role does gold play in one of these well diversified protected portfolios? And then the other thing that I'm always constantly thinking about is something like Bitcoin. So for me, a billionaire, somebody very wealthy, there's only a few ways that you can ever run out of money in your lifetime, and it's hyperinflation or confiscation from the government. So you're constantly doing all of these things to protect against those two main disastrous consequences of having so much money, right? So for me, the allure of something like Bitcoin, the call it the return opportunity are getting too great to actually completely write off at this point. The fact that you can memorize 12 words, strip down bare naked, and walk across a border, and as long as you can log in to internet, and find somebody that's willing to buy that on the other side, you have access to this wealth, which you certainly can't do with your stock portfolio or gold bar. So I'd be curious your thoughts on gold and then Bitcoin as they play into a piece into a well diversified portfolio.
Well, gold's the easy one. I mean, you don't buy gold to get rich. You just buy it as an insurance policy and a store of wealth. And so it makes complete logical sense to own gold. And I would countenance to say that owning gold and owning gold equities are different. And even within the gold equity space, because a lot of clients will come to me and go, "Oh, I'm good. I'm all in gold." I'm like, "Okay, what do you own?" And they'll list a bunch of junior miners, and which can easily go to zero. And so so there's those are different. I just want to make that point because a lot of people sort of go gold and buy a bunch of junior miners or something like that, which is not the same thing at all.
Well, myself included, right? I buy GLD, which is you're trusting that somebody has gold in a vault and they've issued you paper. And it's like, well, it's kind of gold exposure. It's better than no gold exposure, but it's certainly not the same as a bar of gold in my safe that I can shave off pieces for, bread or whatever.
That said, if you're looking at inflationary environments, which I believe we're coming into, the best returns in that space are historically have always been energy. Copper way outperforms gold. So I do think that's likely to happen again. So with bullish gold, we have an allocation towards gold as well as gold miners. So that's, I don't have anything intelligent to say other than anybody else that you would have spoken to who is in that space. With respect to Bitcoin, it's something that everything that you said is true. It has an asymmetry to it, even more so now, I think, as governments clamp down on freedoms of every stripe. And certainly the coming digital currencies that the Europeans, I think they're going to be the first out of the gate with the European digital currency. They certainly look like they'll be the first out of the gate with this great reset that they're talking about, which is likely just to be a asset confiscation, basically stealing people's money and paying off debts, and creating a situation where you are tied into this Orwellian dystopian technologically driven world. I don't think it's going to work, and I think what's going to happen is you're going to see capital shift. It's already shifting. I just spent weeks traveling around Europe speaking to some very smart, very wealthy people, and they all understand. They all have at least some knowledge of what's going on and are doing their best to take measures against it. And so Bitcoin comes into that, in that, as you mentioned, it allows that transferability very, very easily. What concerns me with Bitcoin, and we have an allocation to it, what concerns me with it is that the very reason that it is probably the most, what's the word I'm looking for? It's probably the best asset I can think of to own in a sort of a world where these things are being implemented. Okay. And the very reason that it is the best asset, I think, is also probably the very reason that they're going to ban it. So there's an asymmetry there. Now, what we're going to have to watch for is when and I'm convinced they'll ban it. When they ban it, whether it gets banned across the board, whether every country comes on board with that particular thing or not, is what's going to be important, because all you need is some escape valve where some countries, maybe Japan's always been very pro Bitcoin. They've already said it's a currency, You know, does just not flood towards those exit valves? Because you've got to have an exit.
The game theory is just insane, right? I mean, it just takes one country to go, actually, it's not banned here, and we hold part of our reserves in it. Sorry.
Exactly. So again, what I'm saying is that the risks behind Bitcoin are becoming elevated every single day, at the same time that the rewards for it are becoming elevated every single day. So now the question is, what do you do about that? I believe that you just manage that position in terms of your position sizing. Don't make it something where if you're wrong, it wipes you out. And if you're right, you're going to do fine, right? And you will probably look back and go, I wish I'd put more in. Fine.
Of course.
Rather be that guy than the guy who's like, I got screwed. So that's my thoughts on Bitcoin. I wouldn't be holding, personally, I wouldn't want to own more than like 10% allocation. But I'm not putting it like, make up your own mind. You can,
it varies by person. I mean, all of the disclaimers that we need to put there. So it sounds like copper and energy. I mean, for the average investor, what's the easiest hands-off way of adding these exposures?
Easy. I mean, Freeport is probably the most easy way to go about getting access to copper. That's the biggest, most liquid, well-run company that is diversified across the globe. It tracks copper pretty well. I guess you could go along the Chilean peso. There's problems there, and that Chile's doing some really stupid things at the moment. So
as are most countries.
As are many countries. It's fascinating to watch. To some extent, it actually, that elimination of potential candidates makes it easier, because you're basically just scraping out going, no. And then you kind of look at what you're left with, which makes your investment process somewhat easier.
Yeah, and then that makes a lot of sense. The unfortunate reality with Freeport is when I was in college and I decided that selling naked puts was a great way to make up money. Picking up pennies in front of steamrollers. I bought a lot of Freeport as a young poor college student when I was forced to buy some. And then energy. I mean, oil and gas, uranium, everything. And nickel for the solar play. Like what's kind of your play there?
I'd spend the next half hour just running through all the different positions, but what I would say is this: look at those sectors and then go and do your homework and realize that every company has its own set of risks. You can have a risk that the CEO runs off with the CFO's wife. You could have the risk that a government does something really stupid and they've got a particular asset in that country where the government's doing something stupid. Like there's just so many different risks that you have for any one company, which you don't have with a particular commodity. So part of you would say, well, then you just buy the commodity. No, unless you're an adept futures trader, because then you basically need to step into the futures market. I don't think that's the best way to play it. The other side of it, of course, is that if an underlying commodity moves by 10, 20%, owning the equities makes a lot of sense because the equities can go 10 times that. So what I would look at doing is just building a diversified portfolio across all these different sectors, and breaking that. The way that we go about it with Glenorchy is we'll say 50% roughly, rule of thumb, of a particular sector. I want to own stuff that's not going to go away. So it's companies with very low debt. It doesn't have, it's free cash flow strong. I don't really care necessarily what happens to the share price in the next 6, 12 months, whatever. Who cares? I'm looking 5 years out and saying, are these guys going to be around? Are they going to be still profitable? Cool. Okay. And having at least half of your position in a number of companies like that, bearing in mind what we spoke about before with respect to geographical risk. And then you might take some more risk in terms of buying maybe small caps that have got some leverage and so on and so forth. To the extent where you have position sizing where you've maybe only got 1 or 2% in any one equity. Because look, if you get it wrong, or some government does something stupid or whatever, or there's a fraud, or like a mine gets flooded, for example, no one could see it coming, happens, destroys their cash flows and so on and so forth. If that's a 1% position, it's not going to go to zero, but even if it did, you go, okay, 1%, you're fine, you can sleep at night. One of the biggest things that we have for clients coming to us, wanting us to manage their money, isn't necessarily their inability to understand markets or understand sectors. It's the psychology. It's their inability at times of stress to make logical decisions and to do, and that just comes with time and experience and basically cocking things up a lot and going through those experiences which are they test you. And so
they're not pleasant.
One of the ways that I would suggest, if you're going to manage your own money, one of the ways I would suggest to handling that particular issue is to not be overly exposed to something, because when things work out for you well, it's fine. Yes, you might look at it and go, I wish I had more position in this, It's when things don't work out, and then and I've seen this happen so many times before, and it happened to me in the past. You land up making your decisions based on what the market's doing. So you're just a bloody ball getting bounced around by forces that you don't have any control over. You don't want to be that guy, So, go back to the February-March sell-off that we had. Gratefully, we went into it roughly 70% allocated, so we still have about 30% cash. And from 15th of March, we just started buying aggressively. It kind of bottomed 24th-ish there. So, and you're never going to know when the real bottom is. No one's got a crystal ball, but you look at it and you're like, this is nuts. You have to be buying it. So it was, and I know that there were many clients who came to us after the fact who were like, no, I want you to manage our money, because I went through that and they just sold everything and they just freaked out and they just and so, again, try and position yourself so that you're not that guy. Try and position so that you don't get emotionally whipsawed, so that you understand what you bought, why you bought it, and you can logically look and say, has anything really changed? If the price has changed because the market's going through a liquidity event, has it changed? Is their company still going to be doing what they're doing in a year's time or whatever the case might be. And so, but it's difficult to have those internal conversations with yourself if you're getting emotionally torn up because you're down 30% and you think it's going to keep going, and you just, so it's as much an emotional stability that you need as it is about understanding markets and looking at valuations and all that other nonsense.
Awesome. Yeah, no, that's really good advice, and much harder to do than to say, right? You think you're a logical person and I have conviction in this trade and all of this, and then the bottom falls out for some reason that's outside of your control, and suddenly that conviction isn't so strong. That's for sure. So, Chris, I want to be aware of your time. This was fascinating conversation. Wanted to give you a chance to talk a little bit more about Capitalist Exploits, what you do. Where can my listeners find out more about you, about Capitalist Exploits, or whatever else you want to talk about?
Sure. So the website that we run is capitalistexploits.at, or .com will actually get you there as well. And the service that we run there is basically research that we do for our private clients, that we put out as like a smorgasbord around these sectors, and clients can look at that and choose how to build their own portfolios. And that's a weekly publication we put out, as well as different alerts, special reports, monthly Q&As where people can ask me whatever questions they got, and try and do our best to answer them. And then the other is for accredited investors that want to have their capital managed. That's what we do at Glenorchy. So that's glenorchycapital.net.
Well, really appreciate it. I know my listeners are going to really, really enjoy this conversation. So thanks again. There you go. First off, thank you very much for listening all the way through. I hope you got a lot of value out of that conversation. As always, you can find show notes, links, and more at altassetallocation.com. Please share this with anyone you think might be interested and derive any value from this conversation. And as always, you can reach out to me for any feedback or questions. Please give the video a like, or even better, subscribe on YouTube or your podcast player of choice. This really helps others find the podcast or the video as well. Thanks a lot. Hope everybody has a fantastic day, and stay safe out there and invest wisely. Cheers.